Hello, this is Connie Belden, and we're going to continue on with net present values. We just went over when it's issued at a premium, and we talked about that every 6 months you will have a journal entry that looks like this. I believe I did fail to mention then that the end of 20 years, because you're debiting that premium on bonds payable for $63, by the end of 10 years, when those bonds are cashed in and you have to pay your investors back, the premium on bonds payable account then will be down to zero. Of course, it may be a little off due to rounding here since we took everything to the nearest dollar. Okay, let's look at the same example, but we're going to change the contract rate to 8%. So in this case, the net present value of the bond is at a discount. In other words, we would expect to sell it for below the face value of $10,000. Why? Because we're only paying 8% interest, and they could go somewhere else in the marketplace and another investment similar to ours and make 10%. So therefore, they can make a higher interest rate investing in another company, kind of like you might look around for banks and put your money in the one that has the highest rate for your savings account. So in order to get them to invest in us, the net present value will be less than $10,000. So we'd be willing to sell it for less than $10,000, pay them 8% interest at a lower rate, and then 10 years from now, they will come and cash it in, or it will mature, I should say, 10 years from now, and we will pay them back the face value of $10,000. Okay, well, first of all, it starts out the same. The effective rate has not changed from 10%. Highlight there in gray. So therefore, on the table, we will still be looking at 5% and 20 periods for both tables again. Okay, so let's start with the present value of the bond, $10,000. Again, when we look up on the dollar table, 5% and 20 periods, we get 0.3769. So $3,769 is the present value of the bond. Now, what changes is in Part A. We'll make that a different color, we'll make it yellow. The contract rate is 8%. Remember, Part A here is the only place we use the contract rate. Half of 8% is 4%. So our interest expense is $400 every 6 months. So the holders of our bonds will only receive interest payments of $400, less because we're paying a lower interest rate. Now, just like we did before, we'll take that $400, but again, remember, you look up on the annuity table, not 4%, but the market rate of 5% at 20 periods. So it's actually the same number from the annuity table. Multiply it out, $4,985. So notice that the present value of the bond is less than $10,000. The net present value of the bond is $8,754 when we add the two together. Okay, so to journalize for it, remember the premium we credited. When you journalize issuing a bond at a discount, you debit cash, you credit bonds payable for the face value. Okay, you will debit cash for its net present value of $8,754, but you will debit discount on bonds payable for the difference between the two, which is $1,246. So with the initial issue of the bonds, it's a credit to premium on bonds payable, a debit to discount on bonds payable. Now, for the interest expense every 6 months, keep in mind, I'm going to highlight here, I'll pick a different color, I'll pick pink, that we have a debit to discount on bonds payable for $1,246. Just like with the premium, we have 20 periods that we want to divide that by and spread it out over. So just like with the premium, we will always debit interest expense and credit cash. Cash will be credited for the amount up here in Part A, $400. That's the amount that we'll be paying out in cash for interest expense. However, we have a debit to discounts on bonds payable. So to close it out, I'm going to have to credit it, and I'll divide that 1,246 by 20, and again, that gives me $63. Okay, I'm just going the opposite direction this time. So that will be a credit instead of a debit like it was in the premium. Okay. Now, in this case, you add the two together and interest expense is debited for $463. So notice in both cases, whether it's a premium or a discount, you debit interest expense, you credit cash. Okay? If it's a premium, the initial journal entry, the credit is to premium, but as you're reducing it down with the interest payment, you debit the premium. Here, with the initial issue of the bond, you debit a discount, but as you're reducing it down to zero by the end of 10 years, you want to credit the discount account. Now, I want you to notice too, and maybe you notice that this happened, when a bond is issued at a premium, the actual interest expense is less than your cash payment for interest. And the reason why is because, again, you issued it over its face value, so you're reducing that down. When it's issued at a discount, the actual interest expense is more than the amount you're paying out in cash. And the reason why is because you sold it below its face value, so you're getting it back up to $10,000 before it's cashed in 10 years. Okay, I know net present values can be tricky, but I hope that these videos have helped you out. Thank you very much.